Markets are closed, but risk doesn't observe business hours. Right now, while equity desks sit empty and trading floors are quiet, the variables that will determine how this week opens are continuing to shift. Geopolitical tension accumulates over weekends in ways that balance sheets cannot yet reflect. And for investors who understand how macro stress travels through asset classes, from oil to the dollar to gold to silver, the period between Friday's close and Sunday night's futures reopen is not a pause. It is a compression window. That is what we are inside of right now. Let me be precise about what is happening and why it matters for serious investors watching precious metals, dollar dynamics, and commodity volatility heading into what could be a structurally significant week. The backdrop begins with U.S.-Iran tensions that have moved beyond the level of background noise. Without sensationalizing the geopolitical detail, what we can say analytically is this: the architecture of risk in the Middle East has shifted into a phase where escalation and de-escalation carry roughly asymmetric consequences for financial markets. Meaning, the upside scenario, where tensions cool, produces a modest and temporary relief in risk assets. The downside scenario, where escalation accelerates, produces a non-linear repricing across oil, safe haven assets, and volatility instruments that can move faster than most institutional hedges can adjust to. This asymmetry is important. It is not priced symmetrically into markets yet, and that gap between what is reflected in Friday's closing prices and what the risk environment now actually contains is where serious investors need to be paying attention. The reason weekend geopolitical escalation creates such structural distortion is rooted in something most retail investors underestimate: the mechanics of liquidity gaps. When markets are closed and a risk event develops, a diplomatic breakdown, a military incident, an escalation in rhetoric that crosses a threshold financial markets treat as a signal, the pricing mechanism that normally absorbs new information in real time simply does not exist. There are no market makers continuously adjusting bids and offers. There is no active order flow to provide price discovery. What you have instead is a system under pressure with no release valve. And when that valve opens, when COMEX futures reopen Sunday night, when currency markets begin pricing in Asia, when oil futures react to the weekend's headline flow, the adjustment happens rapidly in a compressed window and often overshoots the fundamental reality. This is not a prediction. This is a structural feature of how markets function during geopolitical weekends. And understanding it is not about being alarmist. It is about being prepared. Now let us turn to where the most important structural tension currently sits in the commodities complex, and that is silver, approaching a resistance level that carries both technical and macro significance. To understand why silver's position matters right now, we need to separate the technical observation from the macro interpretation, because on the surface, a resistance level in silver looks like a chart pattern. But when you situate it within the current macro environment, it reflects something far more layered. Silver occupies a unique and somewhat unstable position in the asset class spectrum. It functions partly as a monetary metal, a store of value that benefits from safe haven demand during geopolitical stress. And it functions partly as an industrial commodity, sensitive to growth expectations, manufacturing demand, and global supply chain dynamics. This dual nature means that during periods of macro uncertainty, silver does not always behave with the clean directionality of gold. It can receive safe haven flows and simultaneously face headwinds from slowing industrial demand. The result is a metal under competing pressures, sitting near a price level where the structural balance is genuinely fragile. The resistance we are watching is not simply a price point where selling has historically emerged. In the current macro context, it represents the level at which institutional positioning becomes contested. Below that level, there is a reasonably stable base of demand from physical buyers, from investors seeking commodity exposure, from macro funds holding precious metals as a hedge. Above that level, the picture becomes more complex. There are participants who have been short silver, anticipating that resistance holds. There are algorithmic systems that treat the level as a trigger for repositioning, and there are option structures whose gamma exposure can accelerate moves in either direction once price begins to breach or reject the zone. What this means practically is that the resistance is not just a number on a chart, it is a point of concentrated positioning risk. And if the dollar reacts to the Iran escalation in a way that weakens it, if gold continues to function as a geopolitical hedge and pulls silver's monetary characteristics into the foreground, the pressure on that resistance level increases. Equally, however, if the dollar strengthens on safe haven demand. If investors move into U.S. Treasuries and dollar cash rather than commodities, then the industrial component of silver's pricing comes under additional pressure at exactly the moment the monetary component is trying to support it. That is the tension that makes silver's current position genuinely uncertain and strategically important to monitor. Let us now contextualize this within the broader cross-asset picture, because silver does not move in isolation. It moves within a system. And right now, that system is under stress from multiple directions simultaneously. Gold's behavior in recent sessions has been instructive. It has been acting as a geopolitical hedge, which means institutional investors and macro funds are using it not simply as an inflation proxy or a dollar hedge, but as a direct response to elevated conflict risk. When gold functions this way, its correlation to other assets shifts. It decouples somewhat from equities, it can move independently of the dollar, and it attracts a category of demand that is less price-sensitive and more urgency-driven. Safe haven demand during genuine geopolitical stress is not the same as speculative demand. It is stickier, it is more institutionally concentrated, and it can sustain price levels that would otherwise look technically extended. The question for gold right now is whether this geopolitical premium is durable or fragile. If the Iran situation de-escalates meaningfully before markets open, some of that premium comes out. If it escalates, the premium deepens and potentially accelerates. The range of outcomes is wide, and the honest analytical position is that both are plausible. What we can say with more confidence is that gold's role as a geopolitical hedge is currently active and recognized by serious market participants. And that provides a floor beneath which significant selling pressure is unlikely, at least in the near term. Oil is the asset class where the Iran variable carries the most direct and immediate transmission mechanism. The geography of the tension, the proximity to critical maritime choke points, the capacity for supply disruption that any escalation in that region carries, means oil markets are operating with a built-in escalation premium that other asset classes do not fully reflect yet. An acceleration of tensions does not simply raise oil prices in isolation, it transmits through the energy sector into inflation expectations, into central bank policy calculus, and into the cost structures of virtually every industrial sector in the global economy. The second-order effects of an oil move driven by geopolitical disruption are more persistent and more structurally disruptive than an oil move driven by demand. This matters for precious metals because in an environment where oil is rising on conflict risk and inflation expectations are re-anchoring upward, the case for gold and silver as monetary hedges strengthens materially. the Federal Reserve's policy path becomes less certain, real yields come under pressure, and the traditional argument for holding hard assets becomes more legible to a broader institutional audience. The dollar's behavior is perhaps the most nuanced element of this entire picture. In a classic risk-off environment, the dollar strengthens. Investors move into dollar-denominated assets, demand for dollar liquidity increases, and the currency functions as a safe haven in its own right. But we are not operating in a classic environment. The fiscal position of the United States, the trajectory of its debt dynamics, and the questions that some sovereign and institutional investors have been quietly raising about long-term dollar reserve dominance, all of these create a scenario in which the dollar's safe haven reflexes may be less reliable than they were in prior geopolitical cycles if the dollar fails to strengthen convincingly in the face of this escalation, or if it strengthens only modestly before reversing. That is a signal, not a definitive one, but a signal worth noting and monitoring. A dollar that does not perform its traditional safe haven function during a genuine geopolitical stress event would be a meaningful development for gold and silver positioning. It would suggest that the composition of safe haven flows has shifted, that some portion of the capital that would historically have moved into dollars is instead moving into gold, into other currencies, or into non-dollar assets. For precious metals, that is a structurally supportive environment. Now let us discuss the mechanics of what happens when COMEX reopens, because this is the most tactically significant moment in the near-term timeline. Sunday night's futures reopen is not simply the resumption of normal trading. After a weekend during which significant geopolitical developments have accumulated, it is the first moment at which the pricing mechanism can respond to everything that has happened since Friday's close. For assets like gold, silver, and oil, where COMEX and related futures markets are the primary price discovery mechanism, this reopen carries outsized significance. The concept of a liquidity gap is critical here. When futures markets reopen after a weekend of elevated geopolitical tension, the initial order flow is typically thin. Market makers are cautious, algorithms are testing the water, institutional desks are assessing positioning before committing capital. In this environment, the bid-ask spreads widen, depth of market decreases, and relatively modest order flow can produce price movements that look, on the surface, disproportionate to their fundamental justification. This is not irrational. It is the rational behavior of participants operating with incomplete information in a low liquidity environment, but it creates a dynamic that investors need to understand. The initial price discovery at Sunday night's open may not accurately reflect the equilibrium that will emerge once full liquidity returns in the Monday session. Prices can spike on thin volume, reverse as liquidity returns, and then find a more considered level as institutional participation normalizes. For silver specifically, sitting at or near a contested resistance level, the liquidity gap dynamic is particularly consequential. If the gap open is to the upside, driven by safe haven flows and geopolitical premium, the initial breach of resistance may be technically significant but liquidity distorted. Sustained follow-through would require full market participation, not just thin overnight flow. Conversely, if the gap open is to the downside, if the dollar strengthens sharply, or if de-escalation headlines emerge before Sunday night, the support structure below current levels comes into focus, and the question becomes how durable that support is in a low liquidity environment. Neither of these scenarios is the base case. Both are risk windows that serious investors need to have mapped before the open. Let us speak directly about the probability structure of escalation versus de-escalation, because intellectual honesty requires us to hold both possibilities with appropriate weight. The case for de-escalation rests on the historical pattern of U.S.-Iran tension, which has repeatedly approached what looked like crisis thresholds and then retreated. Back-channel diplomatic activity, international pressure, and the shared economic costs of sustained conflict have historically created incentives for both parties to pull back from the edge. If that pattern holds, the geopolitical premium in gold and oil partially unwinds, dollar strength reasserts itself modestly, and silver's resistance level becomes a ceiling rather than a floor. The case for escalation rests on a different reading of the current moment, one that emphasizes the structural factors that make this episode different from prior cycles. Domestic political dynamics on both sides, the regional proxy architecture that has become more entangled, and the reduced effectiveness of traditional diplomatic channels all create conditions in which miscalculation is more plausible than in prior periods. If the current trajectory does not reverse before markets open, the risk premium embedded in commodities and safe haven assets is likely insufficient for what a genuine escalation phase would require. What we can say with analytical confidence is that the distribution of outcomes is wide. The market's current pricing reflects neither the full optimistic nor the full pessimistic scenario, and the asymmetry, where downside outcomes are more severe than upside outcomes are beneficial, should inform how serious investors think about positioning and risk management heading into this week. This brings us to the strategic message with which I want to close. The purpose of this analysis is not to produce a forecast. Forecasting geopolitical events is a low-value exercise. What is high value, what separates disciplined investors from reactive ones, is understanding the structure of risk so clearly that you are not surprised by any of the plausible outcomes. If gold moves sharply higher at Sunday night's open, you understand the mechanism and you have already considered your response. If silver breaches resistance on thin volume and then reverses, you understand why that can happen and you are not making decisions based on a distorted initial signal. If the dollar strengthens in a way that creates pressure on precious metals, despite the geopolitical backdrop, you understand the cross-asset logic and you are not confused by the apparent contradiction. Markets that are closed are not markets at rest. They are markets under pressure in a containment structure that will be removed Sunday night. The risk that has accumulated over this weekend, the geopolitical developments, the positioning adjustments that institutional participants are planning, the algorithmic triggers that sit around key technical levels, all of that will find expression when the valve opens. The investors who are prepared for that moment, who have mapped their risk windows, who understand the liquidity mechanics, who have positioned with discipline rather than hope, are the ones for whom volatility is an opportunity rather than a threat. Stay informed, remain disciplined, manage your exposure to the risk windows that matter, and watch the dollar.